So this workshop is going to be perhaps a bit more granular than some of the workshops that you're going to attend, because the subject is it's a technique study. We're not going to talk about macroeconomics. We're not going to talk about gold. We're not even going to insult Trudeau very often. We are going to talk about the how and why of private placements, both debt and equity. All of you in the room are welcome, and some of the techniques that we're going to talk about are going to be germane to your portfolio, irrespective of how you acquire debt or equity securities. But the practice of private placement is, by law, limited to accredited or sophisticated investors. So very generally, to the extent that those of you in the room don't have portfolio values in excess of $1 million, or aren't close friends and business associates of officers and directors, this discussion will only be of intellectual rather than practical interest to you. To the extent that there are among you sophisticated investors who have relatively large portfolios, I suggest that the talk might have more immediate and practical interest. Private placements, very simply, are issuances of either debt or equity directly from the treasury of public companies generally to private investors, as differentiated from aftermarket transactions where you buy stock or buy bonds on the exchange. So the private placement is nothing other than a transaction by and between issuers and investors directly. I like private placements myself, and I like them for two principal reasons. Well, three really. One, they're negotiated transactions to the extent that I go to buy or allocate a large piece of capital to a small company, rather than be exposed to the vagaries of the market where a big purchase order might bring up the price of the stock. In other words, where I might be competing against myself in the market, I can negotiate a transaction with the issuer. And if they don't give me the price I want, I simply say no. Negotiated transactions are good. The second reason that you do a private placement is somewhat more sophisticated, in the sense that usually, not always, but usually a private placement is done by a company because they believe they have some catalytic use of the capital, which is to say there is an upcoming expenditure or investment that they intend to make that they believe will be to the benefit of all shareholders. They're diluting because they think that they can use the capital to such good effect that it is in their interest to increase the shares in circulation in return for cash. The fact that the use of proceeds is often, at least intended, to be accretive and catalytic means that often in private placements, the time frame associated with the amount of time that you would reasonably hold the stock is lower. If you buy an aftermarket security simply because you think the company's assets are attractive, or simply because you believe that the process that they are engaged in will be beneficial, or because you know and love and trust the managers, all good reasons, what you need to understand is that without a catalytic event in place, or the potential of a catalytic event in place, sometimes you become immediately familiar with the difference between inevitable, which means that you think the stock has to go up, and imminent, which means that it goes up quickly. The beauty of private placements often is that the capital is raised to be employed in a circumstance that is catalytic, which shortens the time of your potential holding relative to the effective utilization of capital. The third reason, I hope everybody has pens and paper, because the third reason you have to write down. Private equity placements, if intelligently constructed, have a warrant. A warrant is the opportunity to buy more stock at a fixed price, but not the obligation to buy stock at a fixed price. Meaning that if the capital that you contributed to the company inures beneficially to all shareholders, because you took the risk, you get the opportunity to participate once with the stock you bought, but secondly, after the fashion, you have the ability to buy more stock at a lower price, and theoretically benefit twice from the same circumstance. Write this down. In equity private placements, no warrant, no money. Some of you might remember a former First Lady in the United States, Mrs. Reagan, Ronald Reagan's wife. She talked about, how do I say this politely, teen pregnancy. And she said the real answer is just say no. And with regards to private placements, without warrants, employ the Nancy Reagan defense. Just say no. Now, management teams hate warrants. Management teams find warrants to be dilutive. It's interesting that management teams don't find options, which they get, to be dilutive. Dilution to managers means I get rich. Options mean they get rich. Many times when I walk around the floor and I negotiate private placements, I say, I need warrants. And they say, well, we can't give you warrants. They're dilutive. And I say, well, do you have options? Well, yes. That's management compensation. Then when we're negotiating the warrant, they say, well, we'll give you an 18-month warrant. And I say, well, how long are your options? Well, they're 5 years. So why do you get 18 months? Or why do I get 18 months and you get 5 years? The answer is always the same. Rick, what you're proposing is unfair. I work at the company. And I say to them, that's really interesting. You work at the company most weeks, 5 days a week. But my money is at work 7 days a week. So reasonably, I should get 7/12 of the benefit, and you should get 5/12 of the benefit. Doesn't that make sense? You're employing my money 7 days a week, and you're working 5 days a week. Now, it seems that management seldom agrees with that. And so I try and split it. I try and say, okay. 5-year option, 5-year warrant. By the way, if it's all the same, what you should warrant to me contractually is that if you lower the strike price of your options in a bad market, you should lower my warrant. Everybody with me? I mean, this is very, very important stuff. Many people have looked at the money that certain people, myself included, have made in private placements over the years, and they think just the topic private placement is good. Private placement is just a technique. If you don't negotiate the private placement well, and if you don't place the money well with good people, it's a wonderful way to lose money because you end up with restricted securities. So what is an intelligently constructed private placement? The first thing, aside from structure, is the use of proceeds. When I invested in Empress Royalty, I had a fairly long discussion with management. And I said, tell me what you're going to do with my money. Tell me why the money that I have contributed to you is going to make me wealthier and all of your existing shareholders wealthier. Tell me why it's going to happen in a reasonable period of time. Too often, these guys say, well, with this money back, with this kind of market, you'll have your money back in 4 weeks or 4 months or 6 months. To which, as an old man, I would say, listen, I already have my money back, okay? You got to do better than that. So the use of proceeds, in the case of most exploration companies, the application of the capital to answer some unanswered question around their existing asset base is critical. It may be in the exploration business that a company has a good surface anomaly. They've taken lots of surface samples, and maybe they've done some trenches to make sure that the mineralization goes down to bedrock. And it may be that the unanswered question is, yes, we have the length, we have the width, we want to know the depth, we want to know the third dimension. That's a classic example of an unanswered question. A different unanswered question may be they have 1 or 2 holes in the deposit, but they got to put 10 in it to get some sort of target size. Doesn't matter. What matters is that you understand the nature of the unanswered question. What they propose to do with the money that will increase the market's certainty around the value of their property. Everybody get this so far? Because we're going to go deeper in the weeds, okay? So it's important that you understand that. In addition to understanding in a very gross sense the answer to the unanswered question, you need to know if the amount of money that they raised and the amount of money that they have is suitable to answer the question. It might be that the unanswered question would require 2 field seasons to answer, which is to say in Northern Canada, as an example, 18 months. You need to say, okay, how much money will it cost you to answer the unanswered question? Maybe the company comes back and says $5 million in drilling and field work. Great. How much time will it take? 2 field seasons, 18 months. Great. What's your G&A? $2 million a year. So for 18 months, $3 million. So you add $5 million, which is the project expenditure, and $3 million, which is the G&A. Say, okay, you need $8 million to give me a yes answer. How much money do you have? $1.98. How much money are you raising? $3 million. Well, with $3 million in sources and $8 million in uses, you're $5 million away from being able to give me a yes answer. In that circumstance, if the capital raised isn't sufficient to add value, don't do the trade. Everybody with me so far? Oh, good. Let's assume that they get through that question okay, right? All is good. The second question that you ask is, you are going to answer an unanswered question. You are going to propose and test a thesis. This is really an intellectual capital exercise more than a physical exercise. Why should I care what question you propose? And why should I have faith in your thesis? Who are you? What have you done? And in particular, how specific is the expertise that you plan to supply related to the task at hand? If the person's expertise was operating a producing gold mine in Archean terrain in French-speaking Quebec, and the task at hand is exploring for copper gold in tertiary volcanics in Spanish-speaking Peru, while the person may have been a success, the success isn't related to the task at hand. And I am probably less impressed with their ability to frame a thesis or test the thesis than I would otherwise do. In other words, are the people that you are financing possessed of the correct expertise to employ your capital intelligently? Everybody still with me? I'm sorry, I realize that you came here for me to tell you that gold was going to go to 5,000 tomorrow, but this is a very different presentation. The next thing that I think you have to do, or at least I've learned to do in 40 years of mishandling my own money, has been tell me what could go wrong and tell me how you're going to know when things are going to go wrong. Hundreds of times in my career, I've seen people raise $5 million or $10 million, drill it all. They absolutely, positively have proven that their initial thesis was wrong, and they kept drilling the money. And I ask them, listen, did you guys deliberately drill your worst hole first? Is that what happened? And then you moved on to successively better holes? Were you looking to mislead the market and drill a crappy hole before you hit gold? There are circumstances where intelligent operators, my friend Ross Beatty, will propose a wonderful exploration thesis. 15% of the way into the program, he'll say, oops, that was a mistake. And he has the very good sense to keep 85% of the money rather than waste it. It's important that the people that you have entrusted your money to have in their own mind what can go wrong and what their pivot is going to be. Everybody still with me? Good. If you do this, you will, over time, succeed in the technique called private placement investing. Where and when is the application most practical? In my life, I have found that as a capital provider, as a check writer, I get the best deals when capital is scarce. In a situation like right now, where the markets are suddenly ebullient, the capital window raising is open, all of the dumb money is rushing in. Smart money should not compete with dumb money. Smart money that competes with dumb money becomes dumb. In circumstances where the issuers are scrambling for capital, where you're scared to death about your portfolio of existing stocks, where you're feeling anything but ebullient, understand that all your competition is just as afraid as you are. When capital is scarce, when share prices are low, That's the time when you deploy capital. As a check writer, you want high returns on capital employed. You don't get high returns on capital employed in ebullient markets. Similarly, the where. It's an odd fact of human nature that while we think of ourselves as forward-thinking, fact-oriented investors, we're actually, at the root of ourselves, lizards. We're morons. We think that we absorb information from all sources and we act on it in a rational fashion, which is not what we do. What we do is we search for information that supports our existing prejudices and paradigms. And I'm not saying just you, I do the same thing. And it's very, very, very difficult to overcome this lizard brain. So when we talk about why, right now as an example, everybody feels great about the lithium business. The lithium price is up by 400%. The lithium narrative has been justified in all of your minds by the market performance of lithium. When a commodity is up 400% in price, it's 75% less attractive than it was before it moved, arithmetically. And I'm not just talking about lithium here. I'm talking about the way that you go about a subject. You make money allocating capital where capital is scarce, which means you make money allocating capital in sectors that are unpopular because you're competing with fewer people. When people get excited about a commodity, it is often because the price action of the commodity has justified the narrative. The problem is that the price action has obviated most of the value of the narrative that you should have paid attention to before it was popular. Everybody still with me? I'm a parable for this, okay? I'm a 70-year-old bald fat guy with 2 hip replacements. And I can win the 100-meter dash if I'm the only schmuck that shows up to run. As often as I say this, people don't seem to get it. It's almost like they ask me permission. Well, Rick, I know that you think that lithium is past its prime, it's too popular. But what do you think about XYG lithium? You know what I'm trying to say? In other words, the sex around the subject, the greed around the other person in the country club having made $1 million in the lithium business, makes the narrative so strong that they lose their ability to act rationally. I hope you're still with me in this. And I'm not going to talk now, maybe next year I will. This is a hook to get you back to my presentation next year. Next year I'll talk about debt private placements if you want, because that's always worked out well for me. Sidebar, in any individual balance sheet, but particularly these gamier companies, the worst piece of debt on the balance sheet is better than the best piece of equity in liquidation. What you find as you age a little bit is that they can take away some of your upside if they take away most of your downside. And I like being a debt investor for just that reason. But what I want to leave you with is this. You do a private placement because of timeliness. You do a private placement because you trust in the expertise of the management who are going to deploy your money. You do a private placement because you understand the duration that it will take, and you know that they have sufficient funding to get you a yes or a no answer. You do it in particular because you understand the process by which they're going to answer unanswered questions, the process which could deliver to you a catalytic event. And in particular, on the equity side, you do it to get a warrant so that you get paid twice. The warrant should, as much as you can make it do so, reflect the terms of the options that are enjoyed by management, because the only difference between an option and a warrant is who gets it. You should be happy that if they succeed, they're going to get rich. And they should be happy too if they succeed that you get rich. This is an introduction to private placements. There's lots more to do. By the way, blatant self-promotion. If you want to learn more about private placements, go to this obscure website, ruleinvestmentmedia.com. start listening to the Rule Investment Classroom series, and in particular, watch the videos around private placements. 2 other blatant commercials. If you care about what I think about your natural resources, send your portfolio to Rule Investment Media. I'll rank it. No obligation, no charge. Occasionally I'm right. And if you care about private placements, now that I've given up my securities license, I can tell you what private placements I'm getting into. I do that for free. I don't charge the issuer, I don't charge you. When you go to ruleinvestmentmedia.com, you'll see the drop-down in the question and comment section. If you are an accredited investor, no, I don't check your tax form. Write placements, and I'll put you on a list, and I'll give you notification of the placements I do. No guarantee because I got in, you'll get in. No guarantee because I got in, it'll be a good placement. But it's worth the cost, which is nothing. Ladies and gentlemen, thank you for your time and attention. Best of luck.